You know, when most people think about getting rich in real estate, what comes to mind? It's usually flipping houses on TV or being a landlord collecting rent checks, right? It's the classic American dream. But what if I told you the smartest way to make money from property isn't to own the building at all, but to own the debt on it? Okay, let's dive into this much quieter but powerful path to building real estate wealth. This quote from Robert Kiyosaki just cuts right to the chase, doesn't it? I mean, imagine making money from real estate without ever getting that dreaded 2 a.m. call about a burst pipe. That's the world we're going to explore. The world where you get to be the bank, not the landlord.
So before we get to this alternative, we got to understand the traditional routes. Most people who jump into real estate investing start down one of two very, very well-worn paths. And, well, each one comes with its own special brand of headache.
On one side, you've got the flipper. Their whole game is about capital gains. Buy it, fix it up, and pray the market goes up so they can sell for a big one-time profit. It's exciting, but it's pure speculation. Then you have the landlord. They're chasing cash flow. The goal is super simple. Make sure the rent check every month is bigger than the mortgage payment and all the expenses. Honestly, the pros focus on cash flow, while amateurs are often the ones chasing that riskier capital gains lottery ticket. And if you pick that landlord path, you will inevitably run into what we call the 3 T's. First, you've got tenants, who can be fantastic, or they can come up with 1,000 reasons why the rent is late. Then you've got toilets and leaky faucets and broken furnaces, all the constant maintenance. And finally, trash, just the general mess and headaches of managing a property. It's a very hands-on business. For a lot of people, it feels a lot more like a job than a passive investment. So what if you could get all the financial perks of real estate? That steady income, the security, but without all the hands-on hassles. Let's take a walk to the other side of the closing table. This is where we completely shift our mindset from owning the property to owning the paper on the property. The key to this whole thing is a document called a real estate note, and it's actually pretty simple. It's an IOU, a promise to pay you back, and it's secured by a physical piece of property. Now think about this. The investor who borrows money from you, they have a liability on their books. They have to pay you every month. But for you, the lender, that exact same contract is an asset that puts money into your pocket every month. It's such a powerful idea. One person's liability is another person's asset. A fantastic real-world example of this is a company called R.C. Willey. Now, on the surface, they sold furniture, but they figured out pretty quick that the real money wasn't in selling sofas and dining tables, it was in the financing. By giving their customers loans to buy the furniture, they became a massive lending powerhouse. They knew that controlling the financing is almost always more profitable than selling the actual thing. So how does this actually play out? It's surprisingly straightforward. Step 1, some other real estate investor, a flipper or a landlord, finds a great deal they want to buy. Step 2, instead of going to a big, slow bank, they come to a private lender like you. You provide the loan, which is the note. Step 3, and this is the best part. They do all the heavy lifting. The renovations, the marketing, finding tenants, all of it. And step 4, well, you just kick back and collect your passive interest payments. You've basically outsourced all the hard work. Okay, I know what you're thinking. This all sounds a little too good to be true. Isn't it super risky? What actually protects my money in a deal like this? And that brings us to maybe the single most important concept for any investor, but especially for a lender. It all comes down to 3 little letters, LTV. It stands for loan to value. All it is a simple ratio, the amount of your loan divided by the value of the property. See, a smart conservative lender will never loan the full value of a house. They always insist that the borrower has some of their own skin in the game, and that creates this big protective cushion of equity.
Let's just use a simple example to make this crystal clear. Let's say a property is valued at $100,000. A smart private lender might only agree to loan, say, $60,000 against it. That's a 60% loan to value. So what does that really mean for you? It means there is a $40,000 equity cushion sitting in that property protecting your capital. The borrower has to lose $40,000 of their own value before your investment is even touched.
So this is the key takeaway, the whole thing in a nutshell. For you to lose even one single dollar of your original $60,000 investment, the value of that property would have to crash by more than 40%. That is a massive buffer against a housing market dip, against mistakes the borrower might make, against just plain bad luck. It's your built-in shock absorber. And hey, this isn't some new, crazy idea. This is a core principle from the godfather of value investing himself, Benjamin Graham. He basically said that a huge margin of safety means you don't need a crystal ball. You don't have to perfectly predict what the real estate market is going to do next year, because you've built in so much room for error that you're protected no matter what.
So with that kind of safety built right in, what are the rewards? Let's talk about the payday, the lifestyle, and the actual returns you get from being on this side of the equation. The lifestyle really is the biggest draw for a lot of people. You are earning truly passive income, checks that just show up month after month. Unlike stocks, your money is backed by a real, tangible, physical asset, a house that you can literally go and touch. And like we've been saying, someone else is dealing with the tenants and toilets. And the paperwork, it's a tiny fraction of what a landlord deals with. You're not managing a property, you're just managing a contract.
Now, this consistent stream of income can lead to one of the most powerful and kind of mind-bending concepts in all of investing. And it's totally achievable as a lender. It's the idea of an infinite return. So what on earth does that actually mean? Let's go back to our $60,000 loan. Imagine that, over a few years, through all those monthly interest payments, you've been paid back your entire original 60 grand. But the loan's not over. The borrower still owes money on the note, and it's still paying you every single month. At that point, you have zero of your own capital left in the deal. So every single dollar you get from then on is pure profit, which creates a technically infinite return on your investment.
Okay, now no investment is risk-free. We've talked a lot about the margin of safety, but we have to be real. We've got to address the brutal truth of what happens when things don't go according to plan.
I mean, it's the #1 question on everyone's mind, right? You've lent out your money, the checks are coming in like clockwork, and then 1 month? Crickets. The check doesn't arrive. The borrower has defaulted. What happens next? And here is the unvarnished, brutal truth of it. You have to be prepared for this. If that borrower stops paying, your ultimate tool, your remedy, is to foreclose. That means you start a legal process to take ownership of the property that was securing your loan. So, in the absolute worst-case scenario, the lender is forced to become the very thing they were trying to avoid, the landlord. Now, foreclosure isn't a quick and easy process. It takes time. It involves lawyers, court filings, and it can be a real headache. But it's a very well-defined path. And at the end of that road, the title to that property is legally transferred over to you, the lender. From there, you can turn around and sell it, usually pretty quickly, to get your original investment back plus any interest and fees you're owed.
But here is the crazy silver lining, and it all comes back to our friend, the margin of safety. Remember that $100,000 house you only lent $60,000 on? Well, if you have to foreclose, you end up owning a $100,000 asset for a cost basis of 60 grand plus some legal fees. So even in what seems like the worst-case scenario, you can actually come out way ahead by getting a valuable property at a massive discount.
So really, after all of this, it boils down to one simple question. Both paths involved real estate, but they are worlds apart. Do you want the hands-on, day-to-day job of managing properties and people, or would you rather manage a simple, boring contract that's secured by a hard asset while someone else does all the hard work? The choice is yours.